Hi, this is Joe Cantu, and this is our market and economic forecast for August 13th, 2024.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager.
Hi, Joe Cantu here. This is our economic and market forecast. And the reason I'm making this video is I wanted you to see with your own eyes the actual data showing that the economy is in good shape and is strong, will continue higher, and we believe the stock market will reflect that higher move. It is slowing. There's no question about it. That slowing doesn't mean we're moving into a recession. It just means that the growth of the United States is going to continue higher, but just at a slower pace. So let me tell you this story tracing our history of the U.S. economy from 3 years ago till today, showing you with the data of the charts why we believe that the market is going higher, and hopefully give you peace of mind. First, let's look at the real gross domestic product, and if you notice, it's still going up after COVID-19. Now, if you look at the gross domestic product from 2023 to 2024, again, it is still moving up. Now, let's take a look at employment. If you look at the employment for the last 5 years, you can see there was a big dip during the COVID, and then after that, it started moving up again. If you look at expenditures and spending for the United States, you can see there's a dramatic increase in spending and consumption over the last 5 years, and it is continuing through 2024. How about industrial production? Is it moving up? There was a significant increase between 2020 after the COVID period to 2022. But if you look at industrial production, again, it is still moving up. Now, what happened is because industrial production and there was high spending after 2022, the Fed had to raise interest rates in order to slow down the pace. And matter of fact, housing was just going crazy. There were so many people it was basically a seller's market. They could get any price that they want. So the Fed had to step in and raise interest rates to slow down the economy. That is their way of putting the brakes on the economy. And if you look at the 30-rate mortgage, it went from 3% and it peaked actually at 8% in 2023. But again, the Fed had to put on the brakes by raising interest rates. Now, this is the Fed funds effective rate, but in general, we were at 0 on interest rates from 2020 through 2022, and then the Fed started dramatically raising rates, and he raised rates above 5% in this 5-year period. But even though he raised rates, did it work? And the answer is yes. If you see all of a sudden business sales slowed down, and that's what he was trying to do. He was trying to slow down this pace of inflation, and doing that he had to slow down business and business sales. And you can see over the 5-year period how this flattens out. Now, the Fed funds effective rate is over 5%. It's about 5.33% currently, but it's flattened. It hasn't changed here for a while, but it's possible the Fed may lower interest rates moving forward. If you take a look at the tightening that the Fed did and you look at the consumer price index, you'll see that uh, inflation did slow down. If you take a look at the curve, you can see how the curve is starting to pull back. So the process that the Federal Reserve did, in fact, worked here in the United States. Now, if you look at medium household income, you can see there's a decrease. Now, what's interesting, proof that the economy is slowing a little bit, let's take a look at the gross domestic product year over year. So if you look at the gross domestic product, which is a report card for the United States, look at 2023 January 1st and you'll see that the gross domestic product was 1.8%. If you compare it with the gross domestic product today, it's 1.2%. So there's proof that we have a slowing economy. But that doesn't mean that we're moving into recession, by no means. It just means we're slowing down. And he's slowing the pace of the growth of the economy. But as I showed you in the charts before, the gross domestic product is still increasing. It's almost like you're driving a car and you're doing 70 miles an hour and you're going from point A to point B. Well, you're still going to get to point B, but instead of going 70, you're going to go 60. And that's all it is by raising the interest rates, but it doesn't mean that we're going into recession. Now, if you look at the Fed and how he raised rates, now look at the 30-year mortgage. It had peaked at about 8%, but now the 30-year mortgage rates, they're down at about 6.4%. So, in fact, everything's working what the Federal Reserve put in place. But look at the communication. It peaked very high and then it went down, and then now it's continuing to grow. So you can see that we still have strong growth in the economy, and this is in the construction and spending in the communications area. Again, this shows the peak in the 5-year period of the gross domestic product, and then it shows how the Fed slowed it down, and it's continuing to grow as if you take a look at this chart. How about employment? Proof that the economy will go higher, and the stock market is a reflection of the economy. You'll see that that the jobs number is continuing to increase every month, and this chart simply shows what the employment rate is, and jobs are still increasing. If you look at industrial production, so despite a slowing economy, industrial production is still very, very strong. How about total business sales? Well, again, look at this chart and it shows that total business sales is continuing to increase despite the fact that the Fed raised interest rates. Now, one telltale sign that the business is going to increase, and in our opinion that the stock market will go higher, is a reflection of business inventories. The business inventories, if you look at this chart, is increasing, and this is the last trailing 12 months. Now, if business is slowing, business inventories are slowing down. In other words, if you're the owner of a company, you're not going to stock a bunch of goods that you can't sell, and you're not going to stock them if the economy is slowing down. But if you look at this chart, you can see that business inventories are continuing to increase despite the fact that interest rates are high. So even though interest rates are high, it just slowed the economy down to a slower pace. But proof that the economy is going to be stronger, and we believe the stock market's going to reflect that, is the fact that business inventories remain strong and are actually increasing. If you look at manufacturing, again, manufacturing is continuing to be very, very strong in the United States, despite, again, a slowing economy. If you take a look at the trailing 12 months of 1 year, you can see that manufacturing is on a strong pace to continue to increase. Again, we believe the stock market will reflect this increase and move to higher ground. Now let's look at construction spending and transportation. Transportation is a telltale sign. It's a bellwether sector that we say in the business, slow goes the transportation index, slow goes the market. Well, if you look at this chart, transportation is continuing to increase. In other words, the United States is still spending money, and different vendors and different companies are still spending money at increasing transportation cost and increasing transportation. So by spending more money on transportation, it does mean that the business will go higher, and we believe the stock market will move higher with respect to that. Now let's take a look at our positions here at Cantu Tactical Wealth Management and what we have done. So here's the S&P 500 if you take a look, and you'll notice that it's pulled back slightly. Well, the point about the pullback is the fact that there was a sell-off in tech. If you remember, tech got very, very high, and the market is just catastrophically high. But if you look, it broke certain averages that we monitor. And so when it breaks, in our case, these parameters, we put protection stops in place, which we have done for the portfolio. We have hedged the portfolios. Now, once the S&P 500 gets back on track and it breaks above these points that we have listed, then we will continue to add technology to the portfolio. In the meantime, what we've done is we've added utilities. Since the economy is slowing down, that's favorable to lower interest rates. And if interest rates are lower, one of the favored asset classes are utilities, energy as well. So those positions are slowly being added to the portfolio. Now, if you take a look at the employment rate, the unemployment rate rather, and you look at the unemployment rate, it has just been going. We are at one of the lowest unemployment rates we have been in the history of our country. Now, despite that, we need unemployment, or the Fed needs unemployment to go up. It sounds kind of crazy, but the only way to truly put a brake on the growth of the economy is to have higher unemployment. If you look at the trailing 12 months, that's in fact happening. So because the Fed raised the interest rates, there's now proof that unemployment's going up, and that is also proof that the Fed will most likely lower interest rates. Now, if they lower interest rates, then that means that more loans will be available: car loans, automobile loans, housing loans, things like that. And that is actually jump starts the economy. So with that, we expect the stock market to move higher with that kind of respect. Now, despite the Fed raising interest rates from 0 to 5%, many people believe that it affected housing. It has not. As a matter of fact, if you look at this chart, over the last 5 years, housing is one of our sweet spots here in the United States. Housing is continuing to increase. And why is housing increasing? One of the reasons is there's a shortage of housing throughout the country, especially in the area of the millennials. And millennials are continuing to buy houses. If you take a look at this chart for the trailing 12, despite the high interest rates, new housing is continuing to grow. And this is the supply chart of new housing. Again, it is one of the sweet spots in the country that housing and new homes are continuing to climb, and there's a great supply throughout the country, and we suspect that real estate and housing will continue to grow. In conclusion, we believe the stock market will move to higher ground. We believe that the Fed will lower rates eventually when it's data dependent and he sees the data out there, and that will be favorable for loans at the banks. And a lowering of interest rates will allow the banks to give out more money so that there is more business and more expansion. And with that expansion, what's going to happen? It's going to lead to more construction, more transportation, and a higher stock market ahead. I have some disclosures at the end. Take a listen.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager. Over 10 years ago, he created Cantu Tactical Wealth Management, which actively balances and selects investments based on a tactical approach rather than the traditional strategic management method. Instead of the buy and hold philosophy, he believes in the pursuit of finding investments showing momentum, performance regardless of the direction of the market. His experience includes IRA accounts, 401k rollovers, trusts, endowments, defined benefit plans, 403bs, and 401k plans. Additionally, he served as a night college instructor for seniors, teaching high net worth retirement and estate planning for 14 years. Podcast views and personal opinions are for educational and entertainment purposes only and does not constitute a recommendation. Investing has risk of loss, and you should consult with your own advisors for any financial decisions. Cantu Tactical Wealth Management is a fiduciary, registered investment advisory firm in the states of California, Florida, Georgia, and Texas, providing pure independent advice and money management.